NVIDIA gave up all the gains from the after hours and ended the day almost even with last night. The rest of the Mag 7 dropped an average of 2.5%, including Tesla. This is undoubtedly due to the durable goods index adding another layer of worry to the possibility of a rough quarter coming up for our economy. I'm going to go into every aspect of the economy with a bit of depth today, then talk about Tesla in light of all of that analysis. What does it really mean for Tesla? So this is Randy Kirk. Hit like and subscribe and notify. By the way, I'm going to delay tomorrow morning's After the Bell episode until after the chairman speaks. Chairman Powell speaks. He's going to speak at 10 o'clock Eastern. So by the time I get that created and up and everything else, that's going to make the video come out around 11:10 Eastern or 8:30 Pacific, about an hour later than usual. I don't think it makes a lot of sense for me to do that particular episode until after the chairman speaks, because it could change everything tomorrow. So hope you don't mind me coming about an hour later. Now, did you listen to my earlier conversation with Jeff Lutz? Extremely useful. I'm going to put up a card later on that one if I remember. Coming tomorrow night is Kathy Wood's analysis of the economy. Don't know if you listen to that, but what I do is on Saturday morning after Kathy Wood speaks, I do an analysis of what Kathy Wood said. And this month should be really amazing. And then I do that with Larry Goldberg, and we do that on Saturday morning. So you want to notify so you can make sure you become aware of all of that coming up tomorrow morning and Saturday morning. Of course, there'll be normal materials on the afternoon tomorrow and tomorrow night as well, plus all weekend. Anyway, Patreon, nobody's joining. What's going on? We're stuck at 109 or 110 or something like that. Come on now. All right, let's go on. There is no strong reason for investors right now to move their money out of their money market products. They're stuck in those money market products. Why would you buy the bonds yet? Why would you buy equities? Those money markets are paying really well. Every time it looks like the 10-year bonds are peaking and it might be a good idea to switch over and get some of those 10-year bonds, there's a fear and some indication that they're going to rates are going to go back up even more, which should depress the underlying bond. So the savvy investor, he's waiting until the 10-year maybe peaks at 4.5, or maybe it's even going to go as high as 5%. So it's not time yet. You know how people are. They're waiting. They're hoping that they're going to really get the bottom. Well, and then every time the itchy finger crowd, those are the ones who are sitting on money market or cash or something else, and they really want to get back into equities. Every time that crowd looks for a better deal, a little more risky option, the idea of a recession, no matter how short or shallow, it rears its ugly head with what's been recent: bad prints on PMI, bad prints on manufacturing data, bad stuff going on China, Germany, and now durable goods. And all of that's causing investors to keep their hands in their pockets and just be really happy with their 4.5 to as high as 5.5 that they're getting on money markets and even certificates of deposit. So when you can get that kind of rate, 4.5 to 5.5, when the inflation, when in your head you believe inflation is really at 2.5 max, those are record numbers. And so those kind of real returns are almost impossible to say no to. So what's the economy actually going to do? Is it going to go into recession? Is it not? I've been saying no, absolutely not, no chance, no way, no how. Remember that a recession is an amount that the economy drops compared to a previous period. So you could have a fantastic quarter, and then you could have a slightly less fantastic quarter, and that would be a recession. So you always have to keep that in mind with regard to what we call a recession. But I still don't think there's going to be a recession. I don't think there's going to be 2 quarters in a row that we only grow at some negative number. What happens to Tesla if there's clear evidence that the economy is doing fantastic? What happens to the economy? What happens to Tesla? If we do have a recession, what happens to the economy, to the stock market? What happens to Tesla, the stock, if we have a great market? And so we have all those things to look at. We'll cover all of those. I hope you'll stick with me, because this is, I think this is, I've done my best to think this through very carefully. All right, let's look at the big things in order. that seem to be on investors' minds right now and try to analyze the most likely potential future that might come out of these. Let's start with the big one, inflation. I know it was a dead issue just 3 weeks ago. Somehow it's now back in the headlines. I'm not sure why. Maybe it was the big increase in oil. Maybe it was the Russians stopping wheat coming out of Ukraine ports. Maybe it was uncertainty, caused by misinformation about the direction of inflation. So where are we? Trueflation says we're at 2.6 year over year. Most other indicators like the CPI and PCE have been more in the 4% range for core and 3% for headline and going down. And every indication is it will continue down. The only thing propping up inflation in the Trueflation index is oil/gas. Oil has gone from 68 several months ago to 84 at the top in a very short period of time. And that is reflected in the Trueflation numbers. However, oil has now fallen to 79 in just a week and under 79 today. And that's not showing up in the numbers at all yet. It will show up in the next couple of weeks, as well as gas will start to drop because we're going into the off season, in addition to the fact that when oil drops, gas obviously drops at some point. Not always immediately, but at some point. Moreover, as I reported yesterday, the United States, Canada, Iraq, Iran, Syria, Venezuela are all increasing production. So when you got all that increase in production coming into the oil situation, and you've got less demand because it's off season, yes, winter, months and months away from now, we might have more demand for oil and natural gas as we get into maybe a tough winter, but who knows? We're months away from that. So right now, I would expect Trueflation and or the CPI and or the PCE will start to show that, no, we're getting under 2%. We're headed down to, as I've said many, many times, we could be at zero by the end of the year. We could be in deflation by the end of the year. Now, we have some difficult, again, period over period. So last year, July and August, you had like 9% inflation. So getting that down this year was easier. As the months go on, it gets harder and harder for the year over year comparison to be as strong. I still believe we'll get there. Okay. Because why? Because everything is down. Okay. Now on bonds, that's the second thing that everybody's paying attention to. I think the market crushed today because bonds were going up again, as well as this business with the economy not being as strong as people thought. So bonds will follow the inflation eventually. And when the smart guys see that inflation is definitely headed lower, they will be heading into those long bonds so they can grab the rates, grab those great rates. Right now, 4.2, 4.3 on the 10-year. They can grab that rate. But at the same time, as inflation goes down even more and the bond rates, the yields go down even more, that means the underlying bond goes up. So you can get the great rate and at the same time make a killing on the underlying bond. So I've already heard people, even Ross Gerber, if you know who that is, he was even saying the other day, time to get into that 10-year bond. This is not investment advice. Nothing I'm telling you right now is investment advice. Do your own homework. It is just me connecting the dots about a lot of stuff I've been reading, a lot of people that I've been paying attention to, and over 50 years of experience in markets. All right, money. Now the Fed has another lever. And that lever, they seem perfectly happy to keep drying up the money supply, which creates a restrictive lending environment and puts restrictions on the movement of money. This, I believe, at this point is way more likely. Listen to this now. Let this sink in. Drying up the money is way more likely to change what people are doing, to change their behavior, to change business people's behavior and consumers' behavior if they can't borrow or they can't borrow at acceptable rates. It will slow purchases. It will slow growth. No doubt about it. At some point, it can become crushing. I'm pretty sure that they know it can be lethal to the economy. That would not be, if they go too far, it could be not a soft landing, not even a hard landing. It could be a wipeout. I don't think they're stupid about this, but it's a tricky play to get right. And I'm hoping that at some point, they're going to see they need to lighten up on these lending restrictions and on the money supply so that the regional banks and others can begin to lend more. All right, next on the list of what people are concerned about, housing prices were up this summer, and that had a tiny effect on truflation. But unless mortgages drop by a half point or more, housing prices will revert to norm during the fall winter season. We're going to see housing prices flat to down during fall winter, but next spring and summer, they will be up. There's a little bit of construction going on right now, which will help, but not nearly enough. And by spring and summer, I think you will see that mortgages will be down a little bit, maybe in the 6.5% range. And Katie bar the door, man, it's going to be a really good for the real estate people, except there's still not going to be enough inventory. So there's not going to be enough deals. We can't get enough deals until there's inventory. And the old folks like me, I'm talking about anybody over 45 that's got a mortgage at 3%, they're never going to sell, ever. I mean, okay, maybe if mortgage rates get back down to 3 or 4%, maybe they'll sell. But until that happens, they're going to be in those homes forever. All right, housing construction appears strong, but it can't bail out the economy and it can't bail out the housing market. So we'll see what we will see next spring. So overall, I see inflation going well under 2% by the end of 2023, even though we'll have those harder comparables. But the swing in productivity is what's going to finalize this inflation thing. I know you've heard me talk about productivity over and over again, but I keep hearing it from the really smart guys. There's a few of them out there on CNBC and whatnot. They talk about productivity. I don't see mass layoffs. They're not happening. Much smarter hiring, much more strategic firing. Those things will increase productivity, not to mention the fact that people have now been on the job longer. We're not seeing this flip. We're not seeing people leaving and changing and moving on to the next job like we were seeing a year ago. So you got people on the job longer, obviously they get more productive. You get to fire the ones that aren't producing, that's more productive. You get to hire more strategically, more thoughtfully, that's productive. And then we also saw this morning, even in the difficult numbers that we got in terms of durable products, we saw that businesses were in fact increasing their purchases of durable goods, meaning probably a lot of hardware that might help them to become more productive. All right. Let's go on to the consumer. This is another piece that everybody's very, very concerned about. Lots and lots of conversation. We just had all the retailers just gave their earnings, and many of them talked about the consumer in their talking points. Well, a very nuanced look. So middle class, upper class people still spending normally. Some of the folks with the lower incomes are cutting back. The other thing we saw is that durable goods, the bigger product, the bigger items, the refrigerators, the stoves, the computers, things that are more expensive, everybody seems to be cutting back a little bit on those. Now that gets pent up, that demand gets pent up pretty quick, although we don't know how much of it was purchased during the pandemic because everybody was afraid they couldn't find one. But whatever the case may be, at some point, those durable goods start coming back. Does that happen in 6 months, 9 months, 12 months? Hard to call, but it was very important to pay attention to. And then that was reiterated or reconfirmed by these numbers this morning. Now, it could be, this is a possibility, this is a crazy thing to think about, but it could be a big shift in the overall zeitgeist. You know what the zeitgeist is? The overall way that the entire US economy and the participants in the economy are thinking. Could it be that older Americans are a bit smarter and wiser than they have been historically? We've gone from an average age of under 30 to an average age of over 40. We have people sitting there with big fat bank accounts. They're not willing to let those bank accounts go back to the levels where there's a question about paying the mortgage on time. They like to have that big fat amount in the account. That could be a huge change overall in the way people act as the economy gets old, as the demographic gets older. We saw that in Japan for sure. We almost certainly are seeing that in China right now, according to specific reporting on the ground in China, that people are saving because they've lost their investment in the real estate. Their investments are way down, so they're saving because now they have nothing for retirement. All right, so that is a possible big change that we will have to look at for years into the future. It could be affecting, but it could be affecting right this minute. All right, then China obviously is very big in the news. Lots of people talking about China. The old story was if the United States catches a cold, China gets pneumonia. Well, is it too soon to repeat that story? Anyway, truly, however, China is really having issues. And if you've heard earlier this week on this channel, they're maybe only going to be growing their economy at 3 to 5%. Well, that's a lot less than they're used to, but it's not like disaster. Having said that, there's no doubt that they're no longer the darling of the world for manufacturing and buying cheap stuff. That's now moving to India, Malaysia, Indonesia, Vietnam, et cetera, even to South America and Africa. So China is potentially got a long-term problem. Short-term, the biggest thing would be if the United States, which is the joke about catching a cold, if the United States is buying less stuff, China will feel it. Because a lot of the stuff we buy, the cheap stuff we buy, that stuff we're talking about comes out of China. And that could add to their negative situation. If their economy is having issues, then that in turn does impact the US economy. Lower costs are good for the consumer coming out of China, lower costs out of China or out of Asia, wherever, but it's not good for the US manufacturers who are competing. So China, a worry, but it's not going to be the final nail in the coffin for the US economy. It could be one problem going forward if there is a serious problem. Okay, regional banks. That's another thing. Of course, we've been talking about that for about 6 months now. The continued downgrading and pressure on local banks would worry me a lot more if the Fed seemed more worried, which they do not. So far, the consolidation seems to be working as the weaker are eaten by the stronger. The related commercial real estate issue was supposed to have been a big problem for these banks already, supposed to be a big problem for those regional real estate companies. But so far, there seems to be a lot of interesting workarounds going on right now that may keep this scare from becoming as big as we earlier thought. So I'm going to put the regional banks aside again as not a huge issue going forward. So Fed Chairman Powell speaks tomorrow, and in what might be an introduction to the new higher for longer approach, we heard from we heard this from the Bank of Philadelphia president, Patrick Harker. Quote, right now, I think that we've probably done enough, and it's probably a good idea to hold steady for the rest of this year and see how that affects the economy. We are in a restrictive stance. Do we have to keep going even more and more restrictive is the question, he said. So there you go. That's the restrictive stance on monetary policy, and then the okay, we can stay where we are on the credit, on the interest rates. So what are the biggest worries? These are the big, I'm sorry, those were. Yeah, sometimes I can actually read my own words. Okay. Anyway, those were the biggest worries for the economy. Let's talk about how it affects Tesla. I have run my businesses in recessions, the Great Recession, the OPEC oil embargo, inflation, big inflation, nothing like this, like 20% inflation, no money flowing, interest rates close to 10% prime, and more. Here is what you want your company, here's how you want your company positioned for the best and the worst of economies. Number one, you want new products in the pipeline. Absolutely. So you can be picking up the slack. If your other products are slowing down, you put the new products out and you can pick up the slack and keep your numbers high. Tesla unquestionably has the best lineup of new products in their pipeline of any company now, maybe or in history. Their backlog on Cybertrucks is over 100 billion. Their backlog of Megapacks is easily 40 billion. The Highland refresh may just be a much, much bigger deal than we were thinking it will be. And then there's Optimus, not to mention FSD, not to mention robotaxis, not to mention so many other things. All right, number two, you want to have plenty of cash. You want the ability to keep moving even when your competitors can't. You want to open new territories, advertise when they can't or won't, take away their customers, and all of that takes cash. Obviously, Tesla has massive cash, much more cash on hand than most companies their size. Number three, no debt. Like cash, having no debt is huge. You have the ability to increase production, add new products, keep up your R&D, offer specials, finance your customers' purchase, and generate income just from using the cash, while your competitors are paying painful amounts of interest on their debt. Tesla has essentially no debt, perfectly positioned. Margins. You want to be the margin leader in your industry when you go into any kind of economy. I don't care what kind of economy, good, bad, or indifferent. This allows you to do just what Tesla has done. Lower prices in order to keep factories open. You're basically buying new customers who will be buying more from you in the future. You get your toe in the door with these customers, and if they like you, they'll buy more later. They'll buy another car. They'll buy services from you. They'll buy a rooftop solar, et cetera, et cetera. Number 5, a powerful brand. Well, yeah, maybe Tesla has a powerful brand. What do you think? One of the most powerful in the world. So to conclude, if the economy continues to grow in the next 6 quarters, Tesla will continue to sell every car they can make. They can increase margins by increasing prices and lowering costs. If the economy stalls, they can lower prices as necessary. If there's a recession, they will be positioned to decimate their competition through pricing, advertising, new products, and no reduction in R&D. No need to change the strategy. You just change the price point. So there you have it. I hope that was helpful. Hope that was useful. If it was, please hit like. You know what it does for the algorithm. I hope you stayed with me. Please go back. Here's where I'm going to put the card with the Jeff Lutz conversation just earlier today. You put this conversation together with the Jeff Lutz conversation that I did earlier today. You will have, I think, a power-packed idea of the economy, of Tesla, where things are going right now. And then, of course, hit subscribe, notify, because you want to see Larry Goldberg on Saturday morning. You want to see tomorrow, whatever I'm going to do tomorrow. Anyway, tomorrow morning, you want to hear my commentary after the Chairman Powell gets done speaking. So those are good reasons to hit notify. And then Patreon, if this is worth should I lower the price? If I had a version of it that was only $2, put that in the comments. You'd be willing to go $2 if I offered a $2 version. Maybe that's what I need to do. All right. Hey, it's been great talking to you.